Okay, good afternoon guys. This is again your Prof. Zeus and welcome to another session of financial accounting. Okay, and for this afternoon, what we will be discussing is all about another financial liability, and that is bonds payable. So when you speak of a bonds payable, like a promissory note, it's actually a what? It is a formal instrument of indebtedness, no? It's a formal instrument of indebtedness. Ibig sabihin, ito ay ebidensya ng pagkakautang. Okay, so when you issue or when the company floats bond, they actually need cash for them to be able to say augment their working capital requirements o kaya mga capital expenditures nila. That's why they issue bonds. Okay, now in a bond transaction, there are two parties involved. Okay, one is the issuer. And of course, the other one is the investor. The issuer, bond investor. He actually is the one that requires financing. That's why he's looking for investors who will invest in his bonds. Okay, so once he finds an investor, what he will do is he will ask the investor to pay him a certain amount. So this is the cash proceeds from the bond issuance. Okay. And then what the bond issuer will do is to issue the bond certificate. So in this case, the bond certificate will be issued to the investor. And what does the bond certificate contain? So normally it contains provisions like how much is the interest payment, interest rate of the bond, and of course the interest payment dates as well. So these are just some of the, of course, provisions that may be that is in the bond certificate. Okay, for the of course reference of both parties, issuer and of course the bond investor. Okay, now in the life of the bond, so we have the timeline here. So this is, for example, the issuance of the bond, and then of course until such time that the bond is retired. Okay, retirement of the bond. So this is where the investor will receive the proceeds from the bond issuer will receive the proceeds from the investor, and this is where the payment would have to occur. Okay, so therefore, what are the issues here? First and foremost, during the issuance of the bonds, the question is, how much would be the issue price of the bond? How much is the investor willing to invest or willing to pay for the bond of the issuer, and how much is the issuer willing to pay for the willing to receive from the bond investor, okay, for his bond indebtedness. Okay, and of course in the retirement of the bond, again the retirement price, no? In terms of retirement, the retirement price, will there be a gain or loss on the retirement? Can the bond be retired even before maturity? Of course, the answer is yes. So this is the maturity. Of course, in between the issuance and the bond maturity, okay, what are the possible activities? Of course, we have the payment of interest payments, no? And of course, the possibility of early retirement of the bond. Okay, so these are the things that we are going to discuss for bond transactions. Okay, first and foremost, let us go to the issue price of the bond. So dito muna tayo ha, issue price. How do we determine the issue price of the bonds? Now, recall our discussion about notes payable. We will be using the same, essentially the same procedure, no, for accounting for bonds. Let me just adjust this for a second. Okay, so therefore, to find the issue price of the bonds, we have to again identify there are two types of interest that could play a vital role in the determination of the issue price of the bond. So you have the two types of interest, and the two types of interest are, number one, of course, you have the nominal interest. The nominal interest is also called the coupon rate, because this is the amount stated in the coupon, or what we call the stated interest rate. Okay, so this is the amount that is imprinted in the bond certificate. This is the amount that the bond issuer is willing to pay or promises to pay to the investor. And the other one is what we call the effective interest rate, the effective or the market rate. Sometimes it is also called the yield. So what is the effective interest rate? This is actually the rate being offered generally by those that are also floating bonds or issuing bonds to bond investor. Okay, so as we learned in our accounting for notes payable, okay, situations that can happen is, number one, the nominal rate is equal to the effective interest rate. Now in this case, the bond shall be issued at face amount. But another situation, of course, is that the nominal is not equal to the effective. Either the nominal is higher than the effective or the nominal is lower than the effective. Now, in this case, in these situations when the nominal is not equal to the effective, then we will have what we call either a premium or a discount. Either a premium or a discount. Now, if the nominal is greater than the effective, then this will produce a premium on bonds payable. Why is it? Because the nominal is the stated amount of interest, right? So the nominal is higher, meaning the bond issuer is paying more than the other bond issuers. Therefore, he can ask for more money from the investor. Now, in this case, the effective interest rate is higher. Then there's no bargaining point for the bond issuer, right? So for him to be able to attract investors, then he would have to sell the bond at a discount. So that is essentially the reason why there's a premium or a discount, no? Because if I am the investor, I would like to get more interest. So if the nominal interest rate being given by the specific bond issuer is higher than the others, then I would go for that. However, of course, the bond issuer will say, I'm paying more interest than the others, so I have to somehow get some portion of it back. That's why he's charging a premium. Okay, he's charging a premium. Now the opposite occurs when he's paying less. Then I would prefer to invest in other investors or other issuers of bonds, right? That could give me more interest than the present bond issuer. Okay, so that's the reason why there's a premium or a discount. Okay, now therefore, but again, just like your notes payable, for financial reporting purposes, we will show this at amortized cost. That of course includes the premium or the discount on the bond. Okay, what else do we need to know? Okay, now let's have an example. Say on January 1, 2019, AEG Corp floated bonds, floated 5 million bonds, okay, paying 6% every December 31st. Okay, and then let us assume that is a 5-year bond. And the effective interest rate, effective interest rate is, let's say it's 12%. Okay, so here we will see that the nominal rate is what, 6%, while the effective is 12%. Okay, so if you are the investor, you would go for those bond issuer, okay, who's paying 12% rather than those paying 6%, because you could earn more. But if the bond issuer is really in dire need of cash, then he's willing to sacrifice a bit, by giving you the opportunity to own the 5 million bond, okay, at a lower price. But remember, at the time of maturity of the bond issuer will have to pay you the amount of 5 million pesos, regardless of how much he will receive from you. Okay, so let's have this. Okay, so we have the timeline. It's a 5-year bond. So this is the time of issuance. Then you have the first year, second year, third year, fourth year, fifth year. So you have the 5-year bond. Okay, now at the end of the 5th year, this is where the 5 million principal will be paid, right? And of course, in between, the company will have to, the bond issuer will have to pay the interest. So how much is the interest? That's going to be 5 million times 0.06. So this is 300,000. So every year, every December 31, sorry, the company will have to pay 300,000. Okay, so if you will look at the timeline, okay, you have seen this before. You've seen this when we discussed about notes payable, right? So what we have here is a combination of what? A series of payments that's essentially the same in terms of amount, and of course this single payment, which is the 5 million pesos principal. Now you've learned in our financial accounting for notes payable that when you have this, not essentially the same amount, then we can use the present value of what annuity in order for us to be able to compute it with in simplicity, no? And then this one is the present value of 1. So as you can see, since the bond issuer, okay, is actually promising to pay 2/3 to the bond investor. Number one is he would pay the principal at a time specified, no, in the bond indenture. Okay, it is sometime in the future, and of course the periodic payment of interest. Okay, so by adding up the present value of these two, we will get the issue price of the bond. Okay, let's do this. So therefore the principal amount of the bond is, this is 5 million pesos, while the interest is 300. So we will be using present value of 1 and present value of annuity. Okay, this is 12%. So 1.12 divide 1, 2, 3, 4, 5. 5-year bond, right? So this is 0.5, 5, 6, 7, 4. And then minus 1 divided by 0.12, that would give you 3.6047. Okay, so therefore that's 5 million pesos times 0.5674. Okay, so this is 2,837,000. While the interest is 300,000 times 3.6047. So this is 1,081,410. So therefore the total issue price of the bond is 2837. So this is 3,918,410. Okay, so this will be the price that the seller will is ready to accept, not from the buyer or from the investor, and the investor is willing to invest. Okay, as compared now to the principal amount of the bond, which is 5 million pesos. So therefore there's a difference. The 5 million pesos, that is 1,081,590. And what do we call this? Yes, you are right. We call this the discount on bonds payable. Okay, so this is now the discount on bonds payable. So therefore, what will be our entry? So entry on the date of issuance of the bond, just January 1, 2019, shall be debit cash for the proceeds of 2,837,000. And then you have bonds payable for how much? 5 million pesos. And then of course you have the discount on bonds payable, which is how much? 1,081,400. So 590. Oops. Oh, sorry. This one is 3,918,410. Okay. So this is now our entry, no, for the initial recognition of the bonds. Now, when we prepare the financial statements, no, at date of issuance, among the non-current liabilities, we will show bonds payable for how much? For the principal amount of 5 million. Okay, less the discount on bonds payable. So less the discount of 1,081,590. So therefore the carrying value of the bond is the present value, the issue price of the bond. So that's the amount that we will show in the statement of financial position. So in a way, we have already tackled this one. Okay, but this is of course later on we'll have a variation for this. Okay, so this is now the entry for the acquisition, for the proceeds of the bond, okay, at the date of issuance. Okay, so what are we going to do? Remember, at the maturity date, so 1, 2, 3, 4, 5. At maturity date, what the investor, the bond issuer will pay is actually 5 million, not 3.918. Okay, because in the bond indenture or the certificate, the principal amount of the obligation is 5 million. So therefore, he needs to pay the 5 million. But remember, what's in the books is what? 3.9 million. So what are we going to do with this discount? Again, throughout the term of the bond, then we have to amortize. We have to amortize, no? So this is now one of the events that happened from the issue date up to the maturity of the bond. Okay, so we have to amortize using the effective interest method. Okay, so this is how we will amortize the bonds. Okay, so therefore, let us now prepare the amortization table. Okay, so we have the date, we have the effective, we have the nominal, and the difference between the two, we have the amortization, and of course the carrying value of the bond. Okay, so this, if we try to represent this as A, this is B, so this is what? A minus B. Okay, so there you have it. Now, okay, so on January 1, which is the issue date, 2019, the carrying value of the obligation is 3,918,410. Right? Okay. So therefore, on December 31, 2019, the company will have to pay the interest. Okay, so the nominal interest that they will have to pay is, going back here, that's 300,000. Right? So therefore, we will put that as part of our amortization table under the nominal interest. So this is 300,000. Okay. Now, what is the effective interest here? So the effective is what? The carrying value of the obligation, this one, multiplied by the effective interest rate. So therefore, that is 3,918,410 multiplied by effective of 12%. So this is 470,209. So therefore, the difference is 170,209. Now, are we going to add or deduct? Now, remember, at the end of the 5-year term, this will have to be equal to 5 million. So therefore, any amortization will be added to the carrying value of the bond. Okay, so minus 300,000, that's a 170. Alisin natin yung 0.2 plus 3,918,410. So therefore, this is 4,088,619. So this is now the carrying value of the bond. Okay, now what will be the entries? No? At December 31 of each year, the company will have to prepare the entries. Okay, number one is for them to pay the interest. So therefore, let us pay the interest. So entry on December 31, 2019. Okay, let us pay the interest. Debit interest expense and credit cash. And this represents the nominal interest of 300,000 pesos. And then of course, we have to amortize the discount. the discount that is reflected here, no? We have to amortize this discount. So this is, since this is a debit, what we will do is to credit the discount, okay? And then we will debit interest expense. Then credit your discount on bonds payable, which is how much? In this case, that is 170,209. 170,209. 170,209. Okay, so this is now the entry for us for December 31, 2019. Now let us now take a look at the discount account. Bonds payable. Okay, so we first debited discount for 1 million. This one, 1,081,590. So 1,081. 1,081,590. Right? This one. Okay, so we first debited this for the discount, 1,081,590, and then now we have credited discount for 170,209. So therefore, how much is the balance of the discount on bonds payable? 1,081,590 minus 170,209. So the remaining balance is 911,381. So this is now the remaining balance. So when you prepare the financial statements as of December 31, 2019, that is 1 year from the issuance of the bond, among the non-current liabilities, of course, you have bonds payable for how much? 5 million pesos. And then the remaining less the remaining discount on bonds payable for how much? 911,381. So therefore, less 5 million. So you have 4,088,619. So this is now the carrying value of the bond. Okay. This is also the same as what we have here in the amortization table. Okay, so let us continue. So on December 31, 2020, we will again pay 300,000 nominal interest. Now the effective now is based on the updated value. That's 4,088,619. This one multiplied by 0.12. 12% is the effective. So this is 490,000. Okay, 634. So this is 190,634. And so therefore, the new carrying value is 4,088,619 plus 190,634. Okay, so this is 4,279,253. Okay, again, another year, 12/31, 2021. Okay, so then again another 300,000 as nominal interest, this time times 0.12. So this is 513,510. So minus 0.36, just round it off, plus 300,000. So this is 213,510. We add it again, plus 4,279,253. So this is 4,492,763. Okay, and then another year, 12/31, 2022. Again, another 300,000 will be paid. So times 0.12. So this is 132. So plus 1 minus 0.56. Okay, there you have it. Minus 300,000. You have 239,132. So we have to add it again. Plus 4,492,763. So this is 4,731,895. Now again, on the last year, we would just have to adjust because there's going to be a difference, minimal difference because of the rounding off. So minus 5 million. So we have here 268,105. And this will be equal to 5 million pesos, which is the principal amount of the obligation. Okay, so if this is 300,000, so therefore the effective is, so plus 300,000, so this is 568,105. So this is now our amortization table for our bond transaction. Okay, so as you can see, we have here the amortization of the discount. Okay, so if you add them all up, that should be equal to the discount that we have recognized previously. 209 plus 196.34, 213,510 plus 239,132 plus 268,105. So this is 1,081,590. Okay, so every year the company will have to recognize the amortization of the discount and of course the interest payment. So on December 31, 2020, again we will pay the interest expense, the nominal debit interest expense, and then credit cash. And again, this is for 300,000. Okay, and then we will amortize the discount interest expense and then credit your discount on bonds payable. For how much? Let us go back. So it's 196.34. 196.34. 196.34. So therefore, let us post it here. 196.34. So therefore, at the end of the second year, how much is our amortization? Balance of discount less 196.34. So this is 720,747. So as of December 31, 2019 or 2020, this is the remaining balance of the discount. So this is 2019 and this is 2020. So when we prepare the financial statements, okay, FS as of December 31, 2020, okay, we will have as part of non-current liabilities, we will have bonds payable, again at 5 million pesos, and then less the remaining value of the discount on bonds payable for how much? 720,747. Okay, so therefore how much is the remaining? 5 million. So this is 4,279,253. So this is now the carrying value of the obligation as of December 31, 2020, which is the same as what we have here in the amortization table. Okay, at the end of the second year. Okay, so every year this will be the practice of the company. You know, they have to record the payment of the interest and of course the amortization of the discount, which we already have here in the amortization table. Okay, so essentially at December 31, at maturity, what will happen is, so at maturity, okay, the company will have to again pay the interest expense for 300,000 and then cash for 300,000. And then of course the amortization of the discount interest expense and credit discount on bonds payable. Now if you look at the amortization table, so at the end of the fifth year, the amortization already is 268,105. 268,105. So let's have it here. 268,105. 268,105. So by recording this one, the discount now becomes 0. Okay? It now becomes 0. So therefore, we just have to pay the principal. Debit, notes payable for 5 million. And credit cash for 5 million pesos. Okay, so that's it. Okay, so we have already tackled the issuance of the bond. The issue is the selling price. We also tackled the in-betweens, okay, which is the interest payment and of course interest payments and the amortization of interest. Let's put here amortization. Amortization. Okay, we are done with that, and of course the retirement of the bond with this one. Okay, so at the end of the term, or at the end of the term of the loan or the bond, no, the discount or the premium would be equal to zero because we have already amortized it over the term of the liability. Okay, we have already amortized it, amortize the corresponding discount, or if it's a premium, then premium, okay, over the term of the liability. That's why at maturity date, then the discount or premium would be zero, and what will be left is the 5 million, which is the principal amount of the obligation. Okay, do you understand, guys? Okay, now let us go to another. Let's have another example. Okay, now what if do you have to, okay, so let's have the same example. Okay, kaya lang, gawin natin, nominal is, balik rin natin, nominal rate is 12%, and then the effective is 6. Okay, so let us now have another example. Same example, but then the nominal rate is 12 and the effective is 6. So here the nominal rate is higher than the effective. So therefore, what will happen is what? What can we expect? We will expect a premium. Why? Because investors will be willing to invest in his bonds because he's paying more than the others. Okay, so in effect, he's actually losing more money, right? So what he will do is he will charge a price that's higher than the principal for him to let go of the bonds. Okay, so let's have the timeline again. So 5 years, 1, 2, 3, 4, 5. So at the end of the 5th year, this is where the 5 million is payable. And then in between, of course, every December 31, you have to pay the interest. So that's 5 million times 0.12. So this is 600,000 every year. So every year we will have to pay 600,000. Okay, so as you can see, again, we have two cash flows here. One is this one, which is essentially the same throughout the term of the bond, and then this one, which is not the same. Okay, so here again, we will be using the present value of annuity. So we can compute the present value of the obligation, okay, with speed. And this one, we will be using the present value of 1. Okay, present value of 1. Okay, so let us now do the computation for the issue price of the bond. Okay, so let's do the issue price. So issue price, you have the present value of the principal plus the present value of the interest. So principal again is 5 million multiplied by the present value of 1, and then this is 600,000 multiplied by the present value of annuity. So that's 1.06 divided by 1, 2, 3, 4, 5. 0.7472 minus 1 divided by 0.06. So this is 4.2123. Okay, so let's have this 5 million times 0.7472. So this is 3,736,000 and 600,000 times 4.2123. So this is 2,527,380. So therefore, how much do we have? 3736, 1, 2, 3. So this is 6,263,380. Okay, against the principal amount of the bond, which is 5 million pesos. So therefore, there's a difference of 1,200,000. So this is the issue price. and this is the principal amount of the bond. So this is the premium. Okay, so you have the issue price, the principal, and of course the premium on the bond. Okay, so let us now prepare the entry. So debit cash for how much? The issue price, no? 6,263,380. We have bonds payable credit for how much? 5 million pesos. Okay, so debit is more than the credit. Then we have the premium on bonds payable. For how much? 1,263,380. So this is now the entry, okay, at initial recognition in the books. Okay, so again, there's a difference of 1,263,000, and this is what we call the premium. So what are we going to do? We have to spread this, okay? We have to spread this over the term of the bond, okay? Over the term of the bond. So what are we going to do? We are going to amortize. So we are going to amortize using the effective interest method. Okay, let's do the amortization. Okay, so you have the amortization table here. Okay, so you have the date, you have the effective, you have the nominal, then you have the amortization, and then you have the carrying value of the obligation. Okay, again, if this is A, this is B, so C is equal to A minus B. Okay, so therefore on January 1, the carrying value is 6,263,380. Right? Sorry, here. So on December 31, 2019, okay, the nominal interest is 600,000. Well, the effective is the carrying value 6,263,380 times 6%, 0.06. So this is 375,803. So plus 1 minus 0.8, so 803. Plus 600,000. So this is 2,224,197. Now what are we going to do? Are we going to add or deduct? Remember, at the end of the 5th year, the obligation should be equal to 5 million. So it's actually what? We are actually decreasing the value of the carrying value of the obligation. So we are going to deduct plus 6,263,380. So you have here 6,039,183. And then let's have another one. So this is December 31, 2020. So again, nominal interest of 600,000, and then times 0.06. So this is 362,351. Okay. So minus 0.98 plus 1 minus 600,000. So this is 237,649. Okay, now again we will deduct 039,183. So this is 5,801,534. And then again, let's have another one. 12/31, 2021. Okay, 600,000 nominal times 0.06, 348,092. So minus 0.04 minus 600,000. So therefore this is 251,908. And then minus 5,801,534. So this is 5,549,626. Oops, you're not seeing it. Okay. Okay, then 12/31, 2022. Now this is again 600,000. Okay, and then 5,549,626 times 0.06. This is 332,978. So minus 0.56 plus 1 minus 600,000. So this is 267,022. Okay. So what are we going to do? Again, deduct 5,626. So therefore, this is 5,282,604. Okay. And then again, we will just adjust at the last. This should be 282,604. Okay, for this to be 5 million pesos. Okay, and this is 600. So therefore, how much will this be? So therefore, 600,000 minus 282,604. This should be 317,396. So there you have it. This is now our amortization table. Okay. So this is the carrying value of the obligation at the end of each year. Okay, and then this is the amortization table. Now let us now do the financial statements for FS presentation purposes. Okay, among the non-current liabilities. Okay, so if this is 2019, this is 2020, 2021, 2022, and then 2023. Okay. So your bonds payable now is 5 million pesos here, 5 million pesos, 5 million pesos, 5 million pesos. Okay, no. So, yeah, 5 million. And then, this will be current now. Okay, 0 na. 5 million. Okay, and then the premium. The first premium is how much? 1 million. So plus 1,263,380. Kaya ang ating carrying value is 6,263,380. Okay. And then this one. So you have 1,263,380. Pero nag-amortize tayo, right? So minus. Okay, so sorry, December na pala to. So hindi na pala yan. Okay? So nag-amortize tayo minus 224,197. So this is 1,0,103,9,183. Okay, so plus 5 million. So this is 6,039,183, which is equivalent to this one. Okay? And then, again, 1,039,183 minus 237,649. So this would be 801,534. So therefore, 5,801,534. Okay, and then minus 251,908. So now it's 549,626. So therefore, this 5,549,626. Okay, and then minus 267,022. So therefore, this is 282,604. So this 5,282,604. Okay, so when you prepare the financial statements as of December 31, 2020, this will now become current in terms of classification, no? Because it will be paid within 12 months from balance sheet date. Okay, there you go. So entries, again, we have to record the nominal interest. So that's going to be debit interest expense, credit cash every year for 600,000. And then for the amortization, what are we going to do? This would be a reduction in interest. So debit premium on bonds payable and credit your interest expense. So if the question is how much is the interest expense, this would be your answers, no? The effective interest, which is equal to the carrying value of the obligation multiplied by the effective interest rate. Okay? Did you get it, guys? I hope you do. Now let's have another variation. So what if we'll use the same figures, okay? It's 5 million principal. So the principal is 5 million. And then what else? Assuming that the interest, the nominal is say 12, and then the effective is 6. However, assuming that the bonds pay semi-annual, so semi-annual payments, that is every June 30 and December 31. Okay, assuming that we have this. Okay, so here, what is it? What actually is the difference between this one and the other? Now, this one we are paying semi-annual interest. So, what is the effect of the semi-annual interest? You have to divide the interest, because remember, whenever you are quoted an interest rate, in the absence of any provisions, we assume that the quoted interest is on a per annum basis. So if this is semi-annual, we have to divide. So nominal will be, that's going to be 12% divided by 2, so that's going to be 6% per payment. While the effective would be, that's going to be 6 divided by 2, or 3%. So we will be using this to compute for the value or the issue price of the obligation. But wait, there's more. What about the period? So what we're going to do is we are going to multiply the periods by 2. If it's a 5-year term, then times 2, that's going to be, we'll be using 10 periods. Okay, we'll be using 10 periods to compute for the issue price of the bond. Okay, so let us do this. Issue price of the bond. So therefore, again, present value of the principal and the present value of the interest. Okay, so present value of the principal is, so this is 5 million pesos. Okay, so let's first do our usual timeline. Okay, so okay, so here, so this is every December 31st. So this will be the interest payments. No? So here. Those are the interest payment dates. Okay. So let us now compute for the nominal interest. So nominal interest will be 5 million times, okay, 0.06. So therefore, this is 300,000. So every 6 months, they will have to pay 300,000. Okay, and then of course at maturity they have to pay the 5 million. Okay, so let's now do this. So that's 1.03, sorry. It's 1.03 divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So that's 0.7440 minus 1 divided by 0.03. That's 8.5302. Okay, so that's 5 million times 0.7440. So this is 3,720,000. 300,000 times 8.5302. So 2,559,060. So plus 3,720. 6,279,060. So this is the issue price. And then the principal is 5 million pesos. So therefore, there is a premium of 1,279,060. So if you compare this with the other one, okay, so the premium is a bit different. Okay, this is 1,263, where the other one is 1,279. Okay, but essentially the same. We've just divided the rate by 2, and of course multiplied the periods by 2 as well. Okay, so what will be our entry at the date of issuance? So we will debit cash for how much? For the proceeds, 6,279,060. Then we have bonds payable for how much? This will be for 5 million pesos. And then we have the premium from bonds payable. Now, premium on bonds payable for 1,279,060. So this is our entry at initial recognition of the obligation. Okay. Now, so what will happen is every June 30 and December 31, the company will have to pay for the interest, and so therefore we also have to compute for the amortization. Okay. So therefore, let us do our amortization table. So we have it today, the effective, the nominal, the amortization, and then the carrying value of the bond. Okay? Okay, let's do this. So January 1, 2019, so this is 6,279,060. And then on June 30, 2019, how much is the nominal interest? We have to pay 300,000 nominal, and the effective is 629,79060 times 0.03, 188,372. So plus 1 minus 0.8, okay, minus 300,000. So that's 111,628. Again, what are we going to do? Okay, so at the end, this should be 5 million. So it's going to be, okay, it will cause a decrease. So we have to decrease the value of the obligation over time. 6279060. So this is 6,167,432. Okay. Now on December 31, 2019, again 300,000. So therefore times 0.03. This is 185,023. So minus 0.96 plus 1 minus 300,000. So this is 114,977. Right? Okay. So ang gagawin natin, we have to deduct. So plus 6,167,432. So this is 6,052,455. Okay, so again, you repeat the same procedure, okay, for the rest of the years, no? So this is 2019, 2020, 2021, and then you will have your amortization table for this problem. Okay, am I clear on that, guys? Okay, so we'll stop here for a while, okay, and then we'll resume the session in a bit. Okay, we will discuss about the issue price again of the bonds, but this time there will be a variation on the problem. Okay. Thank you very much for watching, and again, this is your Prof. Zeus. If you have questions, just let me know. You can post your questions in the comments box, but please, if you haven't subscribed to my YouTube channel, please do subscribe, and you may want to share this to help other students as well, so we can help others to also understand accounting and of course finance in a simple way. Thank you very much, and see you again next time. Bye.